Hello, everyone, and thank you for attending another NYAMB webinar education series program. Today, I'm really excited about the topic here because as we are all really super busy right now with just the basics of our business, and we really have to start thinking about the future. And one of the things we should be thinking about is something called soft money loans. Soft money loans, it's not what you think. I think you're thinking in terms of the non-QM stuff with the hard money and some of the loans from yesteryear that were non-conforming. Soft money has a great place for us as brokers and can fit right in with the rest of what we do as part of our business. But I think it's important that we get educated early on this. And again, I know we're all busy, but it's something that we're going to want to do for the future. So today we have Mikhail from Stratton Equities, who is an expert on the soft money. And he's going to explain to us a little bit about what soft money is. But Michael, why don't I take a break right here and let you introduce yourself and tell us a little about who you are, where you've been, and how you managed to become an expert at this.
Thank you, appreciate it, Mark. So I'm the CEO and founder of Stratton Equities. We're a nationwide direct private money, hard money, and non-QM lender. Now soft money as well. We recently introduced soft money. I've personally been in the mortgage industry for 20 years. I bought my first investment property using private money 20 years ago. When I was 19, I bought my first investment property, and I've been pretty much in the industry ever since. Professionally, in regards to buying property, I bought 56 homes over the past X amount of years, generally multifamily. So I have the knowledge on both sides of the equation, the lending, underwriting, and guideline side, plus what real estate investors need to obviously be more successful. When Stratton Equities was founded, we have the widest range of private money mortgage programs under any one roof. Most of our competitors have 1, 2, 3 programs. We have over 20, 30 programs at this time. And that was done purposely because I saw that when I was a real estate investor, regular QM or regular mortgage companies don't make it easy to borrow money. The guidelines are not conducive for investors. The underwriting is not conducive for investors and make it actually very hard to be an investor if you go to regular financing options. So our programs, our guidelines as a company, we make it very easy for the guidelines and it's the process to be a real estate investor and secure financing.
Excellent. Wow. Great. And the fact that you were a prior investor who had to use programs like this means you've been on both sides of the fence on this thing. So that's great. So can you help us clear up the confusion on the difference between, let's say, soft money, hard money, non-conforming of yesteryear, and how all that is different?
So I wrote the article for Scotsman Guide, Hard Money versus Fix and Flip, because it was driving me crazy when people would call in the office and say, I want a hard money loan, but then they want a fix and flip loan, want a rehab loan, or they want a term loan. So a hard money loan is always going to be a bridge. It's going to have very little underwriting, little about the borrower. It's going to be a low LTV. And there's a lot of guideline differences. So if you're talking about a 90 LTV, 75 ARV, 100% rehab, loan, that's not a hard money loan. That's a fix and flip loan. It's way too high of an LTV. Those programs have a significant amount of underwriting, and it's not a hard money loan. So I do a lot to correct terminology in the industry. If it's a term loan, 30-year 5/1 ARM, it's not a hard money loan. That's not probably going to be a non-QM loan or whatever the case may be. It's not a hard money loan. Hard money loans are going to be 60, 65 LTV max, rates in the double digits, little underwriting. It's just an asset-based loan. So it's going to be, here's, you have a property for $1 million, you want 50 LTV, 500 grand, great, here's your money. It's a high risk loan, but because of the equity and the LTV being so low, that's what offsets the risk. That's a hard money loan. So we specialize in all those programs. We have like our hard money program, we generally use for foreclosure bailout. So we have one of the, obviously investment property, we have one of the few foreclosure bailout programs in the market, which we do a decent amount of those a month. But we only do them in metropolitan areas, generally the East Coast. We won't do a foreclosure bailout in the middle of Kentucky somewhere. The property has to have enough value for us. But that is where we would use a hard money program for like a true foreclosure bailout program. Talking about soft money, the most popular program we had prior to coming out with soft money was our term program. So we'll go up to, let's say, 85 LTV. Our rates start at 4.375 on a 5/1 ARM. You can do an interest only. You can do an IO on it. You can do purchase for a purchase 85 LTV, cash out. Pre-COVID, we were at 80 LTV. Now we're at 75. Hoping with guidelines, we can get back up to 80 LTV cash out on our soft money. So people know hard money. Soft money, and hard money is always going to be a bridge. We have to understand that. So soft money is going to be a term loan, 5171, 30-year fixed. It can go for small balance commercial, 1 to 4 family, mixed use. That's pretty much the property criteria type. And it's going to be a term loan. So it's going to be a longer term hold. But the guidelines, because it's soft money, are stricter and more guidelines than hard money. But when you look at less guidelines than a QM loan, right? So a regular QM loan, you go to, TD Bank or a large agency lender, that's gonna be a QM loan. Those rates are only in the 2s and the 3s. So for a soft money loan, you're looking at no tax returns, no income docs, no P&L. It is a no doc loan, so we don't look at job history per se. And rates on that program start at 4.375. It's our most popular program.
So let me clarify. This is not for owner occupied stuff. This is for commercial or non-owner occupied investor kind of things, right?
Correct.
Okay, just want to make sure. So you started to talk about qualifying just a little bit, and I think we're all kind of wondering. So this is pretty different than what we do with Fannie Mae, Freddie Mac, FHA, VA, whatever. Tell us about how you qualify people. You mentioned something about a debt service ratio. Can you get into that a little bit and tell us how you do that?
Sure. I'm going to give you an example. I had a personal friend of mine where his son was looking to buy an investment property down the Jersey Shore, and he reached out to a very large, regular QM agency lender. And actually, you would answer this better than me, but I believe on the agency side, on an investment property, you're maxed at 70 LTV. Well, that's not a very conducive program for an investor. 30% down is a lot of money. So he came to us. Our program on our soft money side was 85 LTV. The borrower had a great credit score. So if you went to the biggest lenders in this country and you did an agency or QM loan, you're going to be maxed at 70 LTV on a purchase. And I believe also they didn't use the rental income. So we'll go to 85 on a purchase, which is huge. No tax returns, no W-2s, no P&Ls. We don't look at any income docs on the borrower. On the debt service, that program I believe is at 1% and not 1.25 on the debt service ratio. And we do not take out 75% like a regular QM loan where they take out 25% for vacancy. I believe that program goes up to 95%. So only 5% vacancy. Again, these programs are designed for real estate investors. We understand sometimes something is vacant. Sometimes they're buying it, then they're going to rent it out later. The regular agency world, it doesn't like investors. Bottom line, they don't want to lend to investors and make it very hard for an investor to secure financing. We have a lot of programs where the money doesn't have to be seasoned. You go to a regular bank, money's going to be seasoned for months. If you get $10 from a different account, they want to verify every single dollar. It just doesn't work for investors. Most investors are moving money around. They have money in equity. They have money in stocks. They're not like your everyday, people. So the way they move their money around, and that does not fit the regular Fannie Freddie guidelines in any capacity. They do in our guidelines. We don't nitpick on those little things that just don't matter.
So, Michael, a question coming up here is this. Let me see if I read it well. Okay, so regarding the debt service ratio as opposed to like the debt ratio that we would have for Fannie Mae. So you're telling us that for 1 to 4 unit residential properties, you can go as high as 85%, or is 85 for 1 unit and it drops to 80 for 2, or how does that work?
1 to 4 unit investment up to 85 LTV on a purchase. Rate and term is 80. As I said, pre-COVID, cash out was 80. That was one of our biggest programs. Now cash out is 75, but I definitely see in the near future back up to 80 on cash out. And again, on debt service ratio, it's at 1%, and we have a 95% vacancy. So 5% vacancy, we take into consideration, not 25% like Fannie and Freddie. So again, it's easier to get a property approved.
Yeah, that's great, because Fannie Mae requires, I mean, as all those brokers know, we have to use 75% of the market rent.
Mhm.
And, you know, that does make it tough sometimes to get a positive cash flow. Now, what if somebody's
Not to cut you off, on the same topic, we can do that same program if the property is vacant or the property is fully rented. The property is vacant, we will go off of the appraisal market rent. So the appraisal market rent is X, we will go off the appraisal market rent and consider the fact that the borrower, after purchasing the property, is going to go get the property fully rented out with long-term leases at market rent. So even though the property, it's a 2, 3, 4 unit property, is fully vacant, we can still do the same program, but we will go off of whatever the appraiser puts down as market rent for your debt service ratio.
all right, wow, that there, you know, I'm thinking just for my own personal use, I can see a lot of investors fitting into this.
I mean, that's what I buy my properties on. To be very honest with you, I use the same program for me.
Yeah, this is so much easier. Now, what if an investor comes, he also has other investment properties? Are you going to go through all those other investment properties and apply this same 5% vacancy factor, or do they have to, how do these properties have to perform? Do you go off their tax returns?
So great question. If the property, and no investor should do this, is in their personal name, then they're gonna unfortunately have to show, I believe it's 2 or 3 months pity per property in personal name. I mean, we did a loan for a guy a couple of years ago. Then in Florida, they had 56 properties at one time, but they were all in the LLC. They were all in the personal name. That would be a disaster. They're all in an LLC, so we didn't look at it. We didn't need pity for those properties, and then we only finance the properties, cared about the properties that we were financing for him. But if you're in an LLC, we're obviously going to verify it, but we don't add it in. We don't need pity for it or reserves or anything of the sort, and we don't look at the rental on that. We leave that alone, unless, as I said, it's in a personal name, which if you're a real investor, should never be in a personal name.
Right, but I do see a lot of these where they were originated in a personal name and then put into the LLC, so that would fit okay.
Yeah, if you transfer it, yeah.
Even though it wasn't purchased originally in an LLC, so it shows up the personal credit report.
As long as the time of our loan is in an LLC, that's what we care about.
Right. Okay. And so in the case where somebody does have this on a Schedule E on their personal tax return, and these are in their personal name, how do we work the calculation or how do you work the calculation to make sure it's not a negative cash flow on that property? Are you using the 5% vacancy factor on those, or are you doing the pity minus the market, the current rents, or are you going off of what is on the tax return on the Schedule E?
No, we just look at the fact that they're going to need. I do forget it's 2 or 3 months reserves per property in personal name. So if their pity is $1,000 for property X, they're going to need $2,000 to $3,000 in liquid reserves per property in personal name. Again, if it's an LLC or a trust or a corp, then we don't need pity on that.
Oh, okay. So there's no further qualifying as far as debt ratio and that stuff. Well, that's good. So that's really good. So if somebody has a retirement account or something like that, can you use the assets in the retirement account as reserves for that?
Yes, it's not going to be 100%, obviously, as you know.
Right. Do you use a portion of the
correct.
Depending on their age, I would say, somebody has.
Depending on what type of retirement account and whatnot, but depending on yes.
Right. Okay. I mean, that is a really great aspect. I mean, I'm speaking to my fellow mortgage brokers. This program sounds almost too good to be true. I can't wait to try one. Honestly, I do want to try one with you, Michael, so I can see how this all goes through. So we spoke before. Michael and I spoke. We had a little pre-interview before this, and we were talking a little bit about how do we, what role does the broker play in getting a file to you? How is that all done? So, I mean, do we go to our Calix software or whatever software we're using, fill it all out like normal, have them come in, sign all the disclosures as normal, and then send it to you?
So
Or
everything we do here is different, and it was all created by me originally. So the way we operate with borrowers, brokers, our underwriting guidelines, our processes. I mean, as a company, we have a tremendous amount of internal software that we use. Our applications are different. So we tried it when we first started the company. It does not work to let, well, any broker, especially a resi broker, submit loans to us because they have no idea how to work in our system. So a lot of brokers like the way we operate. It's more conducive for them. And they have a significantly higher conversion ratio on closed loans when we do it our way. So if you're a borrower, you know, our website, StrattonEquities.com, we have actually a broker portal on there where you can go to broker up top, you fill out a broker registration form, that will go through our CRM, it'll go to one of our loan officers, and then they'll call you in 24 hours, generally the same day. And then whatever scenario you have, they will review the scenario with you over the phone, make sure the scenario fits. We do not just submit loans. We actually, believe it or not, we try to kill loans as much as possible. If a loan is not going to fit, we don't do Hail Marys. We don't just randomly submit the loans and then hope it gets approved. Our loan officers go through the most extensive training in the industry. Their training alone is 3 months up front, every single day, nonstop. So by the time they're done with training, they know programs as good as underwriters do. And if that loan has a 15% chance of getting approved, we aren't submitting the loan. So we go through a very extensive questionnaire up front to make sure that the program fits, and you have to come to us with all the information. If you don't, then you got to go back and get the information. If the loan fits, the loan officer and our processing team works with the borrower directly. We don't accept outside documents from brokers. We have our full system. They send them out digital applications that go to the borrower directly. They fill it out, comes right back to us. We don't do paper emails or paper anything. It's all done digitally with us, and then it goes into our processing and underwriting system, and then it's taken from there. And then obviously the LO works on it. So we pretty much handle the loan from A to Z, from application to processing, underwriting, title, appraisal, the whole 9 yards. And then when the loan closes, the broker gets paid. Our conversion time on these loans, the only thing that's holding, and this is across the board, everybody knows this, appraisals are taking longer right now due to COVID. So we used to close these loans in 20, 25 days. We still could on a soft money or a term loan, depending how fast we get back the appraisal, which is, depends what state, location, and all that kind of stuff. So 20, 25 days, I would say 25 to 30 days is a good estimate if the borrower is very responsive on these loan programs. If it's a bridge, of course, it'd be about a week shorter. But yeah, that's how we handle it with brokers. You go to the website, StrattonEquities.com, fill out a broker registration, and then a loan officer will reach out to you.
Wow, I'm all in on that. Michael, I think that's the best way to handle this because you guys know what you want to do. Well, a question on my screen from the membership is, what does direct lender mean? We've heard this before, so why don't you explain what it means as far as Stratton Equities is concerned?
Yeah, so we lend our own money. We're a direct private money lender, so it's on our own money, it's our own guidelines, our own warehouse lines. It closes in our name. We're on the HUD, et cetera, et cetera, et cetera. So we're not brokering out the loan where like we don't deal with daisy chains. So let all brokers know this. If there's a daisy chain, John gives Mary, Mary gives Mark a loan. Now you're giving it to us. We don't deal with those. Those loans never close. So we only move forward with loans that we know are going to have a high conversion of closing. I mean, we get so many loan requests and so many leads a day that we just don't waste the borrower's time, the broker's time, our time with loans that we don't believe are going to close. So as a direct private money lender, it's our name, we're on the HUD, it's our warehouse lines.
Great. I have another question for you, Michael. I might as well hit you with a few of these.
Go ahead, please.
All right. Will you do manufactured homes that meet Fannie Mae, FHA, Freddie Mac guidelines and are taxed as real property?
So co-ops don't fit our programs, PUDs don't fit our programs, and unfortunately, manufactured homes don't fit our programs at all in the private money world. So with soft money, it's still a private money program. If anybody's dealt with private money, they know co-ops, manufactured homes, and PUDs are something that we just don't like.
Right, understood. And what about, we have a question on the screen here, lender junk fees. Okay, I think we all know what those mean. Tell us what Stratton Equities has for the borrower on that.
Great question. We have no junk fees. We have no upfront fees. The only upfront fee the borrower pays for is the appraisal, which we actually, because of the volume that we do, we get, so we work with two major appraisal companies. We get discounts, which we pass on to the borrower. It's not much, but still a discount that we pass on to the borrower. We don't make $1 on the appraisal. It's all done through AMCs. We have no junk fees whatsoever. If you look at our marketing, look at our website, it clearly says no junk fees anywhere. The only thing the borrower is going to pay for, obviously, their title docs, which is our standard per state. And then generally we have, depending on the loan program, between $1,000 to I think $1,400 $100 underwriting fee. And then obviously, we do charge points. All private money lenders do, but we keep our points as low as possible to make sure, obviously, we don't overcharge the borrower.
All right, another question for you here, and this is coming from me. So, sometimes some of these loans can get a little complicated with the title. Do you guys have an outlet for title where you can just handle the whole thing?
Yeah. So we work with the largest title company probably in the country. Pre-COVID, we were getting title back in 24 to 36 hours. So it was phenomenal. We never had a problem. Title closed quick. Again, because of our volume, we get discounts, which we pass on to the borrower. We don't charge them any of those fees. So we pass whatever discounts we give them title into the borrower as well. And complicated loans with title, as long as obviously we use our title company, we've gotten out of those pinches virtually every single time.
Michael, can borrowers pay points to reduce an interest rate with your company?
Depends on the program. Again, we get a lot of questions that are black and white. And the thing about us, we're not black and white because we have so many different programs. What might not work here might work here. Well, what might not work on this one might work on that one. So the answer is yes and no. Depending on a bridge loan, no. On a term loan, if it's a non-QM loan, possibility. But our rates are already as low as you can possibly get, right? I mean, there is nobody in the private money space on a term loan that's in the 4s. They're in the 7s and the 8s. So if you're starting in the 4s, I mean, that's as close to bank financing as you're going to get, considering the fact that it is a no-doc loan. So all of our loan programs are pretty much no-doc loans. So no P&Ls, no tax returns, no W-2s. We don't look at job history. Argument's sake, if you're under a Fannie or Freddie loan, right, you have to have 2 years of job history or 2 years of an LLC. We don't look at job history either. So they are all no-doc loans.
Great. Let me ask you, in the case where we have a purchase, not uncommon are seller concessions, although they're becoming less and less these days with the market as hot as it is. But is there a limit to what kind of seller concessions can be utilized in a purchase of a 1 to 4 family?
3%.
3, okay, no matter what. That's good. So how do you keep the broker in the loop on all this communication is one of the questions I have on my screen here.
It's in our CRM. So we built our own CRM system. The loan officer obviously is in touch with the broker after the deal gets submitted, and then our CRM has the broker listed as the broker, and every time the loan moves, the broker gets an email directly from the CRM. So application's in, appraisal's been ordered, title's been ordered, et cetera, et cetera, et cetera. Loan is clear to close, loan's gonna fund. So the broker, it's all part of a CRM system. Everybody involved in that loan gets an email on where the loan is in the process.
I like that. That avoids a lot of phone calls back and forth.
Yeah, it does. It does.
It does. So a question on screen from the members. They want to know, so what is the max compensation for a broker in a transaction with you?
Great question. So again, we handle the whole entire loan. Just to recap, when a broker brings us a loan, something else I want to mention, we don't review loans via email. Our loan officers get way too many requests to do things via email, everything's done over the phone. So somebody can email us in at info@strattonequities.com. That will go through our CRM system. That will then go to our loan officer, but you have to have your phone number. The loan officer will then call you and review your loan scenario. We make sure that we don't charge the borrowers too much. So brokers are paid a maximum of 1% of the loan transaction.
And for that, you guys handle absolutely everything, right? Scheduling, closing, everything.
We have a full system here. We have 2 offices, 8,000 square feet. So everything's done in-house. Nothing. The only thing that is outside is title and appraisal. But we obviously have very good relationships with those companies that give us volume discounts, and they work with us very well. So we get better treatment. Like we work with outside title companies, that the borrower will bring, and oh, we can't close for another week because we're too busy. We don't get that with our people. When we're ready to close, we're ready to close. So we have a much higher conversion ratio on that because everything with us is in-house. If there's a problem with the appraisal, we can talk to the AMC, we can get it fixed. If there's a problem with title, we can get it fixed. You got to realize, one big problem with a loan can kill that loan. So we do everything we can to minimize problems on loans.
Got ya. There's a couple questions on my screen, and I have one too. So I guess I'm going to go to the screen. I'll get the members' questions in there first.
What?
You had mentioned before, if the property is vacant, that you would use the PITI and you would apply your vacancy factor based on that. So the property doesn't necessarily have to be producing rental income to determine what you're going to use for a debt service ratio, right?
So something else I didn't mention, you have the main program, which has the highest LTVs and the lowest rates that go to 85 LTV. That program, correct. If the property is vacant, 1 to 4, we will go off of the market rent that's on the appraisal as our debt service ratio. If that doesn't work, we have what's called a no ratio program, which is one of our biggest programs as well, where if the property doesn't debt service, you can still do the loan. The rates are a little higher, still very reasonable. The LTVs go a little lower, but if the property does, so again, it's no doc on the borrower, and then it's firstly a no doc. So it's no doc on the borrower, and then if the property doesn't debt service, we can still do that loan. The rates are a little higher, the LTVs are a little lower, but I think it's maxing at 70 or 75 LTV instead of 85, but we can still do a loan if the property doesn't debt service.
Wow, that's good to know. I'm glad I asked that question again. Tell me about escrows. Are there escrows available for
Yeah.
on this?
All the programs we have, we escrow for the borrower.
Okay. So when we do the PITI, right, and what about mortgage insurance or any of that? Obviously no mortgage insurance, right?
Oh, we don't have any mortgage insurance. We don't do those.
So now my question, and I still have member questions coming in, but minimum loan size. Tell us what's the minimum on this, so we don't.
So our sweet spot is 100,000 to 3 million. We do 100,000 to 5 million. On exceptions, on bridge loans, for larger loans, we have done higher, some properties in the Hamptons we've done for 8-9 million. That is rare, and rarely does the borrower qualify for those loan programs. But generally, our sweet spot, our minimum loan amount is 100,000 to 5 million is where we stay.
The bulk of your business at Stratton Equities, where does the bulk of your business fall into?
The bulk is 250 to 1.5 million.
Okay, great. So now I know where your sweet spots are.
Well, technically the sweet spot is 100,000 to 3 million. We can still do that, but the bulk is 250 to about 1.5.
Okay, great. So let me see what else is on my screen here from other vendors. Okay, so you mentioned you're going to handle everything. So as far as us presenting a loan to you, we are going to get information out to our membership after this webinar is over as to how to contact you directly and or get into your CRM. How do you want us to start presenting product or borrowers to you?
StrattonEquities.com. It's all on the website. We have multiple lead generation forms where as a borrower, they fill out the borrower application form. If they're a broker, they go to the broker form, and then it'll come into our system. Then a loan officer will call them. info@StrattonEquities.com. You have to have your contact information there where you can submit questions, and then again, you'll be reached out via phone. Or then obviously the 800 number, 800-962-6613. And we have loan officers in the office that'll answer the call.
And Michael, right on that website, is that a portal is that a retail portal as well as a portal? I mean,
You
obviously,
can't submit loans through that website. We don't accept loans of people just randomly submit loans, right? And they have to get, you got to go and submit a borrower request for applying, then somebody will reach out to you, or we have the broker portal where it's a broker submission of your information, and then the loan officer will reach out to you, but you can't like submit a loan.
okay, great. Well, I have to tell you, I really feel like this is something that brokers should be looking into, because this kind of fills that gap between, if you're doing hard money, well, this is a no-brainer to add to your product portfolio. And I know we're all really, really super busy right now, but the sooner we start getting familiar with programs like this, the better off we'll be. Just in the event that this someday tapers off, we want to have a lot of product. This is great, Michael. We really appreciate your time coming in and telling us about this. And it seems like Stratton Equities has got it all together. I love the idea of the direct lender. I love the fact that you've eliminated all the junk fees. We have a lot of, there's other players out there with lots of junk fees. The rates seem really super reasonable, and you seem easy to contact. Can brokers contact you directly if they have any further questions, Michael?
They can reach us at strattonequities.com.
That's great. Great. Well, listen, I think on behalf of all the members, we really appreciate having this material presented to us today. I want to remind everyone to stay tuned for other events just like this in the future, and also to stay tuned for more information on the regulatory conference that's coming up very soon at the Westchester Marriott. Edie, are you still in the background there? Can you come out and give us some dates on some things, or not? In any event, we thank you, Michael. Thank you so much again on behalf of the membership, and we really appreciate it. And thank you for your sponsorship too, by the way. And I would tell all the members, Stratton Equities is committed to the mortgage broker community, because they've actually sponsored. Thank you very much. Appreciate it. Have a great day.
You too, guys. Thank you.